Friends, let us look at the questions and some concepts given in RTPs of November 2019 examinations for Accounting Group 1. I'll start with this aspect or an amendment regarding Accounting Standard 11 on treatment for foreign exchange fluctuation. What we'll do is we'll just read that paragraph and then we will dissect that paragraph into small aspects and understand what exactly we mean by that. Let's look at this. An enterprise may dispose of its interest in non-integral foreign operation through sale, liquidation, repayment of share capital or abandonment of all or part of that operation. So basically this discussion is regarding NIFO, non-integral foreign operation. As you know, we have integral and non-integral foreign operation. Non-integral foreign operation means the main head office does not have active control, meaning day to day they don't interfere in the operations, policies and decision making on a day-to-day basis. The branch or the foreign operation operates largely in an independent fashion. That is what we mean by NIFO. Okay. Now this NIFO is can be disposed of in different ways. Actual sale, or we talk about liquidation of that NIFO, or maybe the stake in that NIFO we sell off to somebody, things like that. Okay. Now we can sell off the entire thing, or maybe we can sell off a part of it. Okay. To that extent it is clear. Right. Now the payment of a dividend forms part of disposal only when it constitutes a return of the investment. Why are we talking about this? Listen carefully, friends. When it comes to NIFO, the foreign exchange fluctuation regarding NIFO, we accumulate in foreign currency translation reserve, right? So we accumulate that in foreign currency translation reserve. It continues to get accumulated in FCTR, foreign currency translation reserve, till the NIFO is disposed of or basically shut down. I'll just use a loose word called unless NIFO is closed down. Okay, till NIFO is closed down, the FCTR continues as an item under reserves and surplus, and once the NIFO is closed down, this FCTR goes into P&L. If this FCTR has credit balance, that FCTR will get credit, that amount will get credited to P&L. If FCTR has debit balance, it will get debited to P&L. But when will that happen? That will happen when the NIFO is closed down. That is a simple understanding that we first need to have. Now, what is this amendment trying to clarify, or this important point trying to clarify? It is saying when from that NIFO we receive dividend. What? How can I receive dividend? Yes. NIFO can even be a subsidiary company. Okay, so foreign operation could be a branch or a subsidiary company and so on. So basically say that NIFO is a subsidiary company. If that subsidiary company pays dividend to us, can I say that just because I received money from NIFO, can I say that this amount is considered as repayment? Well, it is not repayment of capital. It is written on capital. It is not written off capital. We are not getting our capital back. What is the meaning of dividend? On the money what we put in, we are getting a return. That is what we mean by dividend, right? So NIFO, you cannot say you are closing down just because you are receiving dividend, unless it is dividend on account of shutting down of NIFO. What is the meaning of this? Friends, when we liquidate that subsidiary company, okay, let's call it subsidiary company. When we liquidate that subsidiary company, as a shareholder, we can receive a stake of that. We can receive worth of that back in the form of cash, or in the form of amount. So when we get that back, then I can say, oh, it is shut down, it is sold off. Now I'm getting my money back. That also is called as dividend. But that dividend is not basically return on capital. It is basically returning of capital. Okay. So when simply that NIFO pays dividend and NIFO continues to be a going concern, I cannot say NIFO is shut down. If I cannot say NIFO is shut down, the dividend what NIFO is paying to the holding entity or the head office, I'll simply call it head office, we cannot say it's shut down, then if we shut down, this FCTR can be transferred to P&L. No, we can't say that. Okay, right. Let's move on to the next point. It's important. We should read this slowly and carefully, understand the intricate aspects here. Come on, let's move to the next point. Remittance from a non-integral foreign operation by way of repatriation of accumulated profits does not form part of disposal unless it constitutes a return of the investment. Okay, so just because dividend is repatriated, what is the meaning of repatriated? Sent, that foreign currency, obviously it's in some other country, that foreign currency dividend was received by, say, the holding company from that non-integral foreign operation. That amount, when we are receiving, that entity is repatriating and we are receiving that amount. Okay, so when we are receiving that, you cannot say that just because I am getting some amount, you cannot say that is compulsorily shut down. I discussed this logic with you just now, right? Move on to the next one. In the case of a partial disposal means what? NIFO, say, has two parts, part A, part B. There are some two factories in that branch or in that subsidiary company. Now, one factory is sold off or one shop is sold off, the other one is not sold off. Okay, in that case, what to do is what we are seeing here. I am repeating, we have an NIFO. Okay, that NIFO could be a branch or a subsidiary or whatever, but it is in a foreign country, non-integral foreign operation. Okay, now say there are two shops or two factories or two godowns, whatever. So I am just saying there are two. I sold off one of the two in the foreign location. Then when I get money back because I am selling off a part, what is the treatment? Read this. Only the proportionate share of related accumulated exchange difference is included in the gain or loss. Okay. Now what I mean by this is, say, part A, part B, shop A, shop B. Shop A and shop B were there in the foreign location, they were our NIFO, and because of shop A and shop B, we have an FCTR of, say, 1 crore in our balance sheet, 1 crore credit balance in our balance sheet. FCTR attributable to shop A, say, is 40 lakhs and FCTR attributable to shop B is 60 lakhs. Right. We sold off or shut down shop A. Okay. Then out of the 1 crore FCTR what we have, what can we do? Out of 1 crore FCTR, 40 lakhs of FCTR which is attributable to the portion of NIFO which is sold off or shut down can be transferred to P&L. Friends, I am repeating, please concentrate. We have a foreign operation which is non-integral in nature. The non-integral foreign operation, I am just specifically saying it has two parts or two shops, shop A, shop B. Shop A we sold off, shop B we continue to have. Now we have our head office, etc. Head office says, hey, shop A, shop B we have, shop A in the non-integral foreign operation is sold off. Now what should I do with the FCTR treatment? Till now, the FCTR, foreign currency translation reserve, what we created on account of this NIFO, say is 1 crore, then you need to ask yourself this next question. Out of 1 crore, what is the FCTR attributable to shop A? What is the FCTR attributable to shop B? Okay, both are part of non-integral foreign operation. Say the FCTR attributable to shop A is 40 lakhs and that attributable to shop B is 60 lakhs, both put together 1 crore. Now, when shop A as a part of NIFO is sold off, what you can do as per the accounting standard, important amendment, for all you know, there might be a straight question from this in your examination. As per the requirement, new clarification given, 40 lakhs which is there in FCTR can be transferred from the FCTR account to P&L account in the current year. Are we clear? Then you may ask me, sir, 1 crore minus 40 lakhs we have transferred. What about balance 60 lakhs? Balance 60 lakhs which is attributable to shop B, which is still continuing, has to continue as FCTR in our balance sheet. Friends, are we clear? The portion which is sold off, transfer from FCTR to P&L. The portion which continues, that FCTR you will also continue in the balance sheet. Okay, read further. The write down of the carrying amount of non-integral foreign operations does not constitute a partial disposal. Look at another scenario. We have our head office, there is NIFO. Under NIFO, say the assets what we had were some 1 crore. Okay, right. Now, those assets, say we invested 1 crore into that NIFO and NIFO purchased assets. We realized that NIFO had some damage in the assets. 1 crore worth assets came down to some 60 lakhs because some 40 lakhs got damaged, etc. Because of which, in our books, for NIFO, we said, hey, we can't carry that at 1 crore. We have to bring it down from 1 crore minus 40 lakhs, so it will be 60 lakhs. That is what we said. I'm repeating, friends, just understand the example carefully. We have our head office or the holding entity. We have NIFO. This head office or holding entity invested about 1 crore into NIFO. NIFO purchased assets out of that. Then out of the 1 crore of assets that NIFO purchased, say 40 lakhs got damaged due to some accident or whatever, or that stock became worthless, whatever the reason, okay. Now, 1 crore worth assets in NIFO came down to 60 lakhs. Now, we made an investment of 1 crore, that is what we are carrying. This 1 crore, we decided it's not going to be worth 1 crore, there is some damage, it's a permanent damage. So, that 1 crore we want to write off by 40 lakhs and we want to bring down the 1 crore to 60 lakhs in our head office or holding company's books also. Okay, now in a scenario like that, when we write off that asset by 40 lakhs, can I say that the foreign currency translation reserve FCTR that we created in the past, say on account of these operations in this holding entity or head office, we created some 10 lakhs of FCTR. Can I write off a part of FCTR now to P&L is the question, because part of assets we are writing off. Because of that, can I transfer part of FCTR into P&L account is the question. The answer is no. The answer is no. Why? This is not shutdown. This NIFO did not experience any shutdown. It is not even partial shutdown. It is a damage or some write-off that is happening, but NIFO did not experience any shutdown. That is why we have to wait for the NIFO to be shut down for you to transfer FCTR into P&L account. Friends, let me just repeat that last point. You have head office, you have NIFO, head office invested into NIFO, head office created some FCTR in the past. Now, out of that investment, say 1 crore of investment we made, in that 1 crore of investment, we wrote off 40 lakhs, okay. FCTR of 10 lakhs got credited here earlier. My question is, when you write off investment, should you transfer a part of FCTR to P&L? No, the answer is you need not transfer. You have to wait for full or partial disposal of NIFO for you to transfer FCTR to P&L. Okay, right. The last point, accordingly, no part of the deferred foreign exchange gain or loss is recognized at the time of a write down. Now, let us look at a few more questions from accounting standards which are given in the RTPs. Friends, the fair expectation to have is that you already learnt accounting standards, you already practiced problems relating to accounting standards, and now you are looking at the revision test paper questions. Okay, so I cannot teach accounting standards from scratch in this discussion, but we can only revise the important aspects based on the questions given. So look at this. Hello Limited purchased goods at the cost of rupees 20 lakhs in October. Till the end of the financial year, 75% of the stocks were sold. 75% sold means 25% unsold. The company wants to disclose closing stock at 5 lakhs. Expected sale value is 5 lakhs and the commission at 10% on sale is payable to the agent. You are required to ascertain the value of closing stock. Friends, closing stock of finished goods should be valued at lower of cost or net realizable value. This we learn as a part of AS2. Here, what is the cost of closing stock? Cost of closing stock is 25% of 20 lakhs, which is 5 lakhs. Net realizable value is estimated selling price minus estimated costs which we are going to incur in the process to complete it, or even in the process of selling and so on. So here to 5.5 lakhs is what we are going to get from sale of this, minus 10% of 5.5 lakhs we need to incur to sell this, means 55,000 we need to incur to sell this item. So 5.5 lakhs minus 55,000 will be 4.95 lakhs. 5 lakhs or 4.95 lakhs, whichever is lower. So what is the valuation of inventory going to be? 4.95 lakhs. But what is the company doing? The company is valuing it at 5 lakhs. No, it should not value it at 5 lakhs. The value should be 4.95 lakhs. Are we clear about this? Right. Move to the next question. This is an AS4 question. An earthquake destroyed a major warehouse of PQR Limited on 30th of April 2019. The accounting year of the company ended on 31st March 2019. So a month later, earthquake occurred. That's the point. The accounts were approved on 30th June 2019. So this event occurred before the board approval of accounts. Loss from earthquake is estimated at 25 lakhs. State with reasons whether loss due to earthquake is adjusting or non-adjusting event, and how the fact of loss is to be disclosed by the company. Okay, so friends, first thing first, as per AS4, if you want to treat something as an adjusting event or disclosure event, first you need to know whether it is a subsequent event at all. Is it a subsequent event? Yes. Why? That occurred after balance sheet date but on or before the board approval of accounts. So it is a subsequent event which is eligible for discussion under AS4. Okay, right. Next point. As per AS4, are there any circumstances or reasons to believe on the balance sheet date that such an event will occur? Nobody will guess that earthquake would occur, right? None of these horoscope people or astrologers also can guess that earthquake would occur. So there is no chance. Now, how do you ensure the accounting treatment for it? It's a significant event, right? It's a significant event, but you don't know, or you don't have any reason to believe on, you didn't have any reason to believe on the balance sheet date that such event would occur. So in such cases, we have to ask this question: is it a significant event? Yes, it is a significant event. Then if there were no circumstances on the balance sheet date that such event would occur, plus it is a significant event, then it can be considered as a disclosure event. It can be considered as a disclosure event. But hold on, you have to ask yourself one more very important question. There is no reason on the balance sheet date to believe that this will occur. This occurred. This is significant. You need to ask one more question. Is it so significant that going concern of the company will be affected because of this? Is it so significant that going concern of the company will be affected because of this? Meaning, because of this, is there a doubt or a question around whether the company can continue the business at all? If the answer is yes, then you have to treat this as an adjusting event. Please understand. Normally, if on the balance sheet date there was no reason to believe that this event would occur, and if the event is significant, you will normally say it can be treated as a disclosure event, or it can be given effect to as a disclosure event, means you will give a note in the financial statements. But if for any reason, even though the event did not have we didn't have any reason to believe on the balance sheet date that such event would occur, such event occurred, plus if there is a serious doubt on the going concern of the entity, then such event should be treated as an adjusting event, wherein you have to go back and adjust the position of assets liabilities in the balance sheet. Friends, are we clear about it? So that is what we mean by the accounting treatment in this situation. Now let us solve a few questions based on Accounting Standard 5, which are given in RTPs. The accountant of Mobile Limited has sought your opinion with relevant reasons whether the following transactions will be treated as change in accounting policy or not for the year ended 31st March 2019. Please advise him in the following situations in accordance with the provisions of relevant accounting standard. Read carefully. Provision for doubtful debts was created at 2% till 31st March 2018. From the financial year 2018-19, the rate of provision has been changed to 3%. Friends, if the provision changed from 2% to 3%, is it a change in accounting policy? No. It is a change in the accounting estimate. Okay? Earlier we estimated it to be 2%, now we estimated it to be 3%. If this change has a material effect, you may disclose a note in the financial statements, but otherwise this cannot be considered as a change in the accounting policy. It's a change in accounting estimate. Right, move to the next point. Then during the year ended 31st March 2019, the management has introduced a formal gratuity scheme in place of ad hoc ex gratia payments to employees on retirement. So maybe till last year, whenever employees retired, we just paid something random. I mean, we never determined anything. We just decided whatever we wanted to pay, we paid. That was ad hoc ex gratia payment. Now we brought in a formal system for payment of gratuity. Will this be called as change in accounting policy? No, it's not called as a change in accounting policy because earlier there was no policy at all, right? Earlier we just decided, okay, I like this person, okay, 10 lakhs I'll give, 5 lakhs I'll give. Like this we decided, on an ad hoc basis. Now we are deciding that based on a principle. So it's not actually change in accounting policy. You are bringing in a new system into place only now. So we cannot treat this as a change in policy, right? Then previous year, the furniture was depreciated on straight line basis over a period of 5 years. From the current year, the useful life of furniture has been changed to 3 years. Till last year, 5 years. Now we change that 5 years to 3 years. This is also change in the accounting estimate. It is not a change in the accounting policy. Then we have next point. Management decided to pay pension to those employees who have retired after completing 5 years in the organization. Such employees will get pension of 20,000 per month. Earlier there was no such scheme of pension in the organization. I think we already covered something like this. It is a new scheme introduced, so it's not called as a change in the accounting policy. Then last one, during the year ended 31st March 2019, there was a change in cost formula in measuring the cost of inventories. What do you mean by change in cost formula? Say earlier we followed FIFO basis for determining the cost of inventory. Now we are moving to weighted average basis, right? So, or maybe earlier we followed weighted average, now we want to move to FIFO. So wherever specific identification of inventory costing is not possible, entity can choose a suitable cost formula, generally FIFO or weighted average. Earlier we chose one, now we are changing to the other one. Is this called as a change in the accounting policy? Yes, this is called as a change in accounting policy, and the effect of this change has to be disclosed suitably in the notes to accounts. Now the next question is based on Accounting Standard 10, interesting one. Look at this. Srishti Limited contracted with a supplier to purchase machinery which is to be installed in its department A in 3 months' time. Special foundations were required for machinery which were to be prepared within this supply lead time. Means in 3 months we need to do some foundation work. The cost of the site preparation and laying foundations were 1,41,890. These activities were supervised by a technician during the entire period who is engaged for this purpose of rupees 45,000 rupees per month. So basically this person at 45,000 rupees into 3 months spent full time only on this work. Okay, that means to get this asset ready. Then technician services were given by department B to department A, which billed the services at 49,500 per month by adding 10% profit margin. one department had a technician. That technician gave service to this department, department A. The bill what this department gave to this department B gave to department A is for 49,500. But clearly they said in that this department B charged a 10% profit. The question is, when there is a resource in the company in some other department, when they are used for manufacturing or constructing some asset, can there be a notional profit? See, I'll call it notional profit because department B is not a separate company, right? Department B is a part of same company but separate function. They are giving a resource to department A, maybe for internal recording purpose or internal discussion purpose they can have, but for financial statements, can department B actually generate an invoice which will go into financial statements at 49,500? No, that is not permitted. Inter-department profit, what is the profit? 10% is the profit, right? So, 10% profit plus 100 rupees of actual cost put together, department B billed on department A. So, what is the actual cost? Actual cost is 45,000. On 45,000, 10% profit margin got added. So, into the cost of asset, what can go? Only 45,000 can go. Remember, notional profits cannot go and get capitalized as a part of AS10. Okay, right, move on to the next one. The machine was purchased at 1 crore 58 lakhs 34,000 inclusive of IGST at 12%, for which input credit is available to Srishti Limited. Okay, input credit is available to Srishti Limited. What is the meaning of this? Please concentrate carefully. We have paid 1 crore 58 lakh 34,000. It includes 12% what we paid towards GST. It includes 12% what we paid towards GST. Now, the question is, should tax called GST paid for acquiring that asset form part of the capitalization value of asset as per AS10? The answer depends on whether the tax is an adjustable tax for which we have input credit, or whether it is a non-adjustable item. Say, if we don't have any concept of input credit for this item, for whatever reason, maybe for our business input credit we don't have, we have opted for some composition scheme or whatever, we don't have input credit. In such a case, this amount of tax what we paid should form part of the cost of asset, means that also should sit in the capital value of asset. The fixed asset value should include even the tax portion. However, if this amount of tax can be considered as input credit, then you should capitalize only the asset value without input credit. So friends, how do you understand this? 100 rupees is, if 100 rupees is the actual cost, 12 rupees is the GST, right? So 112 is the amount what we paid, just as an example. If 112 represents 1 crore 58 lakhs 34,000, 100 represents how much? Like that you need to make a calculation. Let us quickly see. 1 crore 58 lakh 34,000 into 100 by 112. This is 1 crore 41 lakh 37,500. That is the component of asset which can be capitalized, okay, as a machinery. Now, 55,700 770 transportation charges were incurred to bring the machine to the factory site. Of course, direct transportation should form part of the cost of asset. An architect was appointed at a fees of rupees 30,000 to supervise machinery installation at the factory site. That is directly identifiable cost only for this asset. For the asset to come into the present form, location and condition which will make us get the asset ready for its intended use, that should get capitalized. Then ascertain the amount at which machinery should be capitalized under AS10 considering IGST credit is availed by Srishti Limited. Internally booked profit should be eliminated in arriving at the cost of machine. This examiner is too nice a person. That person is giving all these hints. Actually, that sentence is not required. In fact, I would say last two sentences regarding IGST credit is available. If it's already mentioned, and internally generated profit should be eliminated, that is a part of accounting standard. These two are not required. Come on, let us calculate what the asset value should look like. So we already calculated 1 crore 41 lakh 37,500 plus. Now we have this amount of 1,41,870 plus 3 months 45,000 rupees of salary. 45,000 into 3, 1,35,000. So basically we are not considering that 49,500, we are considering only 45,000. Then we already got this 1 crore 41 37,500 over. Now 55,770 plus 30,000, that comes to 1 crore 45 lakhs 140 rupees. Okay, that is the value of the asset which we can capitalize as per AS 10.